December already, oh my gosh, where did 2019 go? And it's about this time of year that I start to get the questions about where should we be investing for 2020 and how do I make $1 million next year? So I thought I'd just give a quick recap, or forecast rather, of where I think investment markets are heading next year and beyond. First, we'll start with bank accounts, term deposits and interest rates. It's no surprise that they are low and widely tipped to go lower. So cash and term deposits have never been a great long-term investment, and this is even more so the case now, where you're getting less than 2% for money in the bank, less than the rate of inflation. Sure, safe, guaranteed, but not a great long-term investment strategy. So make sure you only keep what you need to in bank accounts and term deposits. Next, we move along to residential investment property, which after a really strong 2015, 16, 17, came off the boil a little bit 2018, but then at the start of this year, investors came back into the property market, stock levels dried up, record low interest rates saw property prices start to increase again. I think property remains a great long-term investment despite not falling back to base bargain prices that many people thought it might do after the really strong couple of years previously. The Australian share market, should we invest there? Currently, the Australian share market is paying a dividend yield of 4%. If you include tax franking credits, a little bit over 5.25% dividend only. Not a bad cash return on your money. Sure, there's some risk, but paying much higher than term deposits and cash, so a great income paying investment. And business health in general in Australia seems to be okay. Certain pockets are struggling, certain pockets are going quite well, but overall business health seems reasonable. On the global front, it's a little bit different. Some countries now have had zero interest rates for over 5 years. Switzerland, Japan, France, Germany, you get nothing on your money for putting it in the bank. Their economies are a little bit different and undergoing some fairly strange economic fundamental things affecting there. Looking to the US market, again, Donald Trump has been surprisingly really quite a blessing for the return of US shares. They've had another strong year, led by the technology sector, and doesn't look like changing anytime soon. The US economy looks to be in reasonably good health. So again, we remain invested in global shares. And then looking at alternative investments such as infrastructure, we remain invested and positively invested in infrastructure investments, tapping into wind farms, airports, toll roads, all of the sorts of assets that governments traditionally used to own and manage but are now outsourcing to the private sector. We like the look of those assets as well. So for 2020, our advice to clients is remain invested, remain diversified, and we see compelling reasons to keep invested in all of the aforementioned asset classes. We wish you a Merry Christmas and a happy and prosperous 2020.